Hello, everyone. I'm Jolene Carey Pace, the Program Coordinator at the Wilkes University Small Business Development Center. I'm so happy that all of you could join us this afternoon for our webinar on how to successfully start a business during a pandemic. This is our fourth of 5 sessions in this series, and this afternoon's session is on preparing financial projections. Before we begin, I would like to thank Ray Hayden and Kristen Sassy, two of our business consultants at the Wilkes SBDC, for presenting today. Just one quick note before we begin to please put yourselves on mute so that we can avoid having any background noise. Also, as we go along, you can type any questions that you might have into the chat box, and there will also be time at the end of the presentation to ask any questions that you might have. And now I'll turn the program over to Ray and Chrissy. Thank you.
Hi, everybody. My name is Kristen Sassy, and I am the consultant manager at the Wilkes University Small Business Development Center. Ray and I are going to be splitting the presentation up today, but not to kind of make fun of myself. Ray is more the financial projection guy, the financial guru in our office. So he's pretty well adjusted with financial projections and all the different statements that go along with it. I know
holds her own too, to be completely honest.
Thanks, Ray. I know some of you were on the seminar last week, and we started talking about, the business plan and the narrative section. We really went through that last week. And I said last week, there's 3 parts to the business plan. There's your narrative section, the financial projection section, and then you have your appendix section. And today's focus is on all the financial projections, really what the lender wants to see to approve you for any type of financing. So, Ray, do you want me to move it forward, or are you going to?
No, I thought I would control the slides.
Okay, you could go ahead and move forward then.
Okay.
And again, the objectives for this presentation, I know if you've been on this the past 4 weeks, we keep kind of introducing the Small Business Development Center. That's kind of just a formality for anyone who is new on the presentation to let them know, what our services are and how we could help them. But really your financial projections, it's going to be a great exercise in answering the question, is it worth it for you to start this business? Do you think that you could make enough money taking a look at, your startup expenses, what your monthly expenses are going to be, and what your loan amount and interest on the loan is going to be able to pay back the loan and keep this business afloat? It's really a great tool for anyone, even if you weren't seeking financing. I always encourage my clients to do at least a break-even point to make sure it's feasible. Could you manage the sales that you're being dealt to keep the business afloat? Another reason or objective for the presentation is, again, when you're seeking any type of financing, the business plan, the financial projections are really a presentation piece for the bank, the lender, the economic development agency, investors, whoever you're seeking financing for. So to have a strong business plan in place and strong financial projections is really important when seeking financing, because the truth is they're not going to lend you money if you don't know about your business and you don't know about the numbers you're talking about in the financial projection section. And so again, you may have seen this slide before in the last few sessions, just about the Small Business Development Center or nonprofit organization. So our services are at no cost to our clients. Everything we talk about with our clients are confidential, so we can't disclose any of your information to anyone. Our funding comes from the Small Business Administration, DCED, and Wilkes University. A lot of people think that we are the Small Business Administration, and that's just not the fact. We just get a large portion of our funding from them. They're a different entity. The small business development centers are not a direct financing institution for small businesses. We work a lot with the clients to get them to the bank or the lender to ask for the financing, but we don't provide any type of financial assistance to them. Our county territory is Carbon, Columbia, Sullivan, Luzerne, and Schuylkill. There's actually 17 centers across the state of Pennsylvania, and every county in Pennsylvania is covered by a small business development center. And so, what Ray and I are going to talk about today is really, what we give our clients that we're doing consulting with in our meetings, with the forms we give them to fill out so we could help them develop their financial projections. One thing you have to understand is that we can't make up the numbers for you. These are your numbers. This is your business plan. We don't write the business plan for you, and we do not develop projections. Everything we do is based off of the information and data that you give to us, because who better knows your business but yourself, and who better is going to know the numbers but yourself and the industry that you're getting involved with. The three statements that we really get involved with are going to be your income statement, your cash flow statement, and your balance sheet statement. These are the three financial statements that are developed from our workbooks. The first year is going to be broken out month by month, and it'll generate the income statement, the balance sheet, and the cash flow statement. And then the following 2 years are going to be annual assumptions. And again, it'll generate the same thing, the income statement, the balance sheet, and the cash flow statement. And then right at the end of our projections is our loan amortization schedule. So based off of the amount of financing you need, your startup expenses, and your cash injection, we figure out, your loan payment, the interest on the loan, and it'll be clearly stated in all the financial statements. So again, probably, all three are important, but the income statement really you're going to take a look at, and it's really a financial statement that shows how profitable your business is over a given period of time. So when you're looking at the income statement, you're really going to see everything. You're going to see the revenues that you're bringing in month to month, your direct expenses. So they're going to be your direct expenses associated with your direct costs associated with your business. And they're going to be, cost of goods. You're going to have that listed in the income statement. And then to further down, you're going to list all of your monthly expenses. So, what are you going to be spending in advertising? What are you going to be spending on utilities each month? Rent, if you're renting a place and not purchasing a place. Sometimes expenses come up that we don't even have listed in the worksheets that are just more prevalent to a certain type of industry. Bad debts, if there's any type of bad debts, you have to take into account people not paying you. So looking at the income statement, and filling out all these numbers is vital, because at the end, you're going to calculate the interest on the loan in your statement. And then, you're going to show at the bottom line, are you making a profit? Is your business profitable at the end of the day? The next statement is going to be the balance sheet statement. And really a balance sheet, it's a financial statement that reports a company's assets, liabilities, and equity at a specific point in time. So, it's a snapshot of what's going on with your business at the time. When we develop our balance sheet, we actually just do an opening day balance sheet, because that's, how the lenders prefer to see it. It's just going to be what is going on that opening day. And then finally, you're going to have your cash flow statement. And this is going to be pretty important to the bank, because their biggest concern is, hey, could they pay back this loan? Are we going to get our money back from what they're making from the business? And I apologize, my phone's ringing. I'll just give it 1 second. I'm going to mute myself for 1 second. Okay, Sorry, someone answered it. Again, I apologize for that, but the cash flow statement is really going to tell how you could pay off your debt. So it's going to, all the statements are going to flow together, but the cash flow is really going to flow from the income statement. If you're making a profit at the end of the month with your income, and then it'll revert over to the cash flow for you financing back to the bank.
All right, guys. So for my section of the presentation, what I'm going to do for you is I'm going to go over a couple of Excel templates, all right, that kind of embody, when you get right down to it, the financial statements that Chrissy had been talking about. And I also want to take a moments to go over some relevant aspects of our first step workbook, where if you become clients of the Wilkes SBDC, you can certainly have access to the entire thing. But for the purposes of this presentation, I thought it would make sense just to go over the ones that are relevant, of course, to this presentation. So let me start really quickly with this first template, all right? Now you'll see here, we work with you, of course, in terms of figuring out, helping you to facilitate your budget. Now, remember, like Chrissy said, this is really driven by you guys as the small business owners. You're the ones that have to figure out precisely what your budget's going to look like, what your needs are going to be, and to a certain degree, to a high degree, in fact, to figure out what kind of financing opportunities that you want to participate in. Quite honestly, there are ones out there that are through the government, through one of our funders, for example, the SBA. And we can help you navigate the processes and the pros and cons of the various programs. But that being said, we're the type of consultants that don't force anything on you. It's completely your choice. Here, we'll see that there's the funding and the various costs. When you get right down to it, your sources, or another way of putting it, your sources and your uses of funds. Your sources and your uses of funds always are supposed to equal out, okay? Now, various costs could be like working capital, for example, but no matter what is going to be on each end, they all should match when you get to the totals. Like Chrissy had mentioned, you're going to want to break down the first year into month-by-month increments, so the first 12 months. And the reason you do that is because lenders want to ensure that you are aware of the nuances related to your business or the nuances of starting up. Be honest, when you're starting up a business, it's probably going to be a ramp-up situation. Rarely, if ever, do we see small businesses that just hit the ground running all day, every day, right? There's usually a kind of, the first month might be a little slower as you're looking to realize some like business recognition for your new operation. Or conversely, you're going to have to take into consideration the seasonality of your business, all right? And what that might entail. If you're like a Christmas tree farm, for example, and just that's the one thing that came to my mind right now. Maybe your busiest months are going to be towards the end of the year, right? The third quarter, okay? If you're a nursery, you're definitely going to be subject to seasonality. Maybe your busiest months are the spring into summer. So these are all things that you have to take into consideration. And if you don't take it into consideration and you don't appropriately reflect it in your statements, it's going to give lenders and other folks that are looking to invest in your business a little bit of pause. Kind of like what Chrissy said, it gives a sense that you might not know your business if you can't anticipate these sorts of things, all right? So your annual income, the first 3 years are annualized. Obviously, the total of the 12 months of the first year is going to be your total for year one, right? And then adjust for the second year and the third year. And that's usually something that we can work through. Oftentimes, I see projections increase by a 5% increase across the board. If there's a deviation to that and you anticipate significant growth, I'm not saying that doesn't happen. It can, but you should have good justification for as to why your business is going to go gangbusters, for example, for year 2 or year 3, all right? This is the balance sheet. And this is just, like I said, Chrissy had explained everything, but I would like to, or I really want to give everybody kind of like a visual. And I apologize if folks are already real familiar with these statements, but obviously they're a very important aspect of the financial projections. Otherwise, we wouldn't be going through them right now. But the balance sheet is essentially a breakdown of what an operation owns and what they owe, or what they own and how did they get there. All right. So what you own is considered the assets of the balance sheet. Okay. So the cash that you have, if you're a business that extends services or products on credit, then you're likely going to have accounts receivable. If you have products, then you're going to likely have inventory, right? If you have a property, then that's going to show up as part of your long-term investments. And if you're somebody that, say, develops software, or your business revolves around software, maybe you might have something called intangible assets, something that's definitely an asset, but you can't really like touch, like a piece of furniture or a vehicle, or equipment. The same thing would go, for example, if you had a bar. Now, you'd probably have those things, right? You'd have furniture, you'd have inventory. But the liquor license, just as an example, would be considered an intangible asset. I mean, you can't really feel a license. You can't really touch a license, right? How did you get there, or what you own? All right. So I have all this cash in the bank, or I have these long-term assets, like a building, for example. How did I get them? Well, maybe I borrowed money to get them, right? So that would show up as part of a liability situation, okay? That would be likely long-term debt. You'll see something here called current portion of long-term debt. That refers to the 12 months of the next, or the rolling 12-month period of a long-term debt. So let's just say you owe, I don't know, $10,000 on a long-term debt, right? And $2,000 is payable over the course of, say, the next 12 months. Well, that $2,000 would show up as part of your current portion of long-term debt. Chrissy had mentioned loan amortization schedules, and that's essentially how you derive the difference between your current portion long-term debt and your long-term debt, okay? If you defer your income taxes, that would show up as a long-term liability. This is your owner's equity, what you put into the project, okay? So let's just say you bought a building. The building was $100,000, all right? And then you needed to borrow $80,000, okay, to finance that building. Totally not uncommon. And then you put $20,000, which is pretty standard, guys, 20%, to purchase the building. Well, your owner's investment specific to the procurement of this particular asset would show up as follows. The long-term debt would be $80,000. The owner's investment would be $20,000. And the long-term investment would be $100,000. And to Chrissy's point with her slide, this is another situation where both sides need to equal, where the assets equals the liabilities plus the equity that you have into the project. All right, any questions? I don't have access to my chat box. I don't know why. So I can't see if there are
There's no
comments or
questions
anything
in
like
the
that.
chat box.
I'm sorry, what was that?
There's no questions in the chat box, right?
Alrighty, and that we have here, similar. So the cash flow statement highly is informed by the income statement, okay? Because that makes a lot of sense. Because the income statement reflects the revenue of a business, right? Now, in this particular example, cash from, there are three ways where you can get cash from, all right? From the operations, what your business does on a day-to-day basis, all right? Actually, the sources and uses of funds fall into these three categories. Operations, all right, so like the revenue that you realize, but also like the things that you need to pay for in order to stay in business, like your inventory purchases, for example, or your operating expenses. Those are all cash to and from operations. Next, we have your investing activities, okay? So if you have like a piece of equipment, right? But let's just say you don't need that equipment anymore, or it doesn't make sense to have it because you've decided to move your business into a different direction. You no longer need to like make widgets, and you sell that piece of equipment. Well, obviously the idea is that you would get cash for it. So that's a situation, that's an example where cash from investing comes into play. All right. Now, if you make purchases in equipment or furniture or something like that, or leasehold improvements, let's just say that you decided to invest in new equipment because of the efficiencies you intend to realize. Those are investments into equipment, and that's cash paid to property and equipment. And those are just simple examples, guys. Um, and then financing activities also. Obviously, if you're looking at borrowing money, that's cash from financing activities, all right? If you're also looking at paying down debt, that's cash towards your financing. So that's where the to and the from situation comes in terms of financing, okay? And then next, like I said before, similar to the income statement, the first 12 months of your cash flow is broken down month by month. And this is really important for lenders because this also shows beyond seasonality, an awareness of seasonality, that you have an idea as to how to manage your cash, okay? So, and where your cash balances lie. And if there's going to be a deficit, because that's not out of the realm of normal, right? When you get right down to it, especially if you have a business that is subject to seasonality. There are going to be high months, there are going to be low months. And what you do in terms of the low months and what you do in terms of the high months matter. During the high months, do you have a strategy to conserve capital, all right? And what is that? And then is that strategy robust enough to carry you through the leaner times? And then once that is established, the cash flow statement is articulated on an annualized basis. Okay. Now, Chrissy had mentioned the loan amortization schedule. We have an example here where the loan amounts, and you know what, if you've ever borrowed money or, you have like a mortgage or something like that, this actually probably isn't totally foreign to you. But we have here a 20-year term, 5% interest rate, and a loan amount of $100,000, okay? And you'll see here that the total 12 months that I had mentioned here, the total of month 1 through 12, if you're doing an opening day balance sheet, shows up as your current maturities of long-term debt. And the difference is found in the long-term debt proper, okay? Another thing to take into consideration, guys, you should know this if you've borrowed money before, but look how much money is going to interest as opposed to principal. That's a bank strategy. Banks make money off of the interest, so take that into consideration too. And maybe depending on the interest rates that you're paying also, what your strategy is in terms of repayback, okay? Now, the one thing I want to show you from this other template is another cash flow statement, because splitting things up between operating, investing, and financing, some folks that resonates with, some folks look at something that's a little more straightforward, and something that's a little more all-encompassing. In this particular example, what we have here is your sources and uses of funds, where your sources of funds are articulated with bank loans, your owner injection, things of that nature. Okay, and then your uses of funds are here presented by what you might need in order to start up your business. Okay, maybe it's inventory, maybe it's equipment, this, that, and the other thing. All right, and here what this shows is that the difference, you start off with a beginning balance, you take into consideration what your borrowings are, how those monies are deployed, and what you're left with is a platform for cash when you start up. This ending cash balance should be reflected on your opening day balance sheet. And that's kind of to Chrissy's point, how these statements all kind of like interact in a manner of speaking together, all right? And then where the monies come from, your gross profit, and where it's taken out, whether it's bank payments, whether it's an owner's draw, whether it's operating expenses to give you your ending cash, all right? This kind of takes lenders on a journey as to like the different things that you expect yourself to go through when you get right down to it to get you to the end of the year, all right? Like I mentioned before, the seasonality of things, the peaks, the valleys, and how you manage your capital. The next thing that I want to show you guys are some excerpts from our First Step book, okay? And you'll see here that this is an articulation of an annualized for 3 years profit and loss or income statement, okay? So we see here, and I love going through this sort of stuff because I'm that nerd that thinks that financial statements tell stories to a certain degree, or you get an idea of what they are just by looking at the financials. So we see here that we have a business that has like pretty decent growth, moderate growth. Right now, we look at this direct cost of sales. And if you look at it, direct cost of sales, they're not a huge component to sales proper, right? It's a small percentage. And I always look at things from like a proportion of sales. Actually, a lot of bankers and credit analysts look at it from the same perspective. So what this tells me is that maybe this isn't a manufacturer, maybe this is more of a service-oriented business where there's not a huge direct cost component, right? And then the gross margin, this gross profit, is the difference between your sales and your direct costs, all right? Like Chrissy said, direct costs, if you're a manufacturer, or if you're somebody that sells a lot of stuff like products, that's also coined as your cost of goods sold, all right? But take a look here, your payroll. So it looks like it's relative to sales. It's pretty human resources intensive. You have a good amount of money going towards salaries, which tells me further articulates to me that this is a service-based operation. And you'll know these nuances. These are things that are really important to take into consideration when you're working on formulating your projections, right? Because if you have huge cost of goods sold, but you're like a pet sitter, there's something wrong, and your lenders are going to think that you don't have a grasp, on your operation. Okay. So sales, marketing, these are things that they take into consideration. And it looks like this particular operation has spent a lot of money with regard to like sales and marketing and less for the second and third years, probably because they're looking to ramp up, some ramp up customers and get the word out and get people to notice their business. All right. Marginal changes with utilities, virtually no changes with insurance. Lofty rent amount, this tells me that they don't own the real estate, right? Some things that you just make practical connections, right? They're renting it. Payroll taxes, they go up because salaries go up year to year. The payroll taxes are tied, kind of like a dependent, independent variable sort of situation, tied to the increase of salaries. The total from payroll all the way to, in this particular example, payroll taxes, all these constitute your operating expenses, all right? And this is your earnings before interest, depreciation, and amortization, which banks look at before you take out non-cash like deductions. That's what banks look at to help facilitate an idea of credit worthiness and debt service, all right? Your ability to pay your obligations, all right? And you'll see that interest expense was accounted for here. In this particular scenario, there's a net profit that, well, actually it's a net loss, it's negative 375. And then the following years, there's a projected increase where it's beyond break even, okay? Is this a bad thing that it showed negative? This is practically break even. What banks also want to know is how you're going to weather, like I had mentioned before, there might be a negative net profit, say in a given month. What are you doing about that? Okay, do you have reserve cash? Do you have a situation where this is maybe a side gig, or this isn't your main full-time thing, and you have ancillary income coming up from say a full-time job. These are considerations that banks have when they're looking to lend you money. I know there's, oh, so this is Doggy Paws. So it's essentially an example that's based on like grooming. So grooming, service-oriented operation, which helps to explain the minimal direct costs, all right? There's some text here, guys. I'm not going to go through it, but I also want to articulate to you the various tools by way of templates that we have for your review and for you to complete. A personal financial analysis. Why is this important? Well, if you're going to make this your full-time gig, it best cover, what your obligations are. You want to live off it, right? Otherwise, why do it full-time? And this makes you real aware of what you have going on, all right? Maybe it's house payment, maybe it's rent, maybe it's maybe you have $110 in credit cards. These are just on the very right examples for you. Various operating expenses. Usually I suggest to clients to fill this out from like an average sort of situation, because gas and electricity, I mean, it's probably going to be higher around now versus, in the spring or in the summer if you're living in Northeast Pennsylvania. And the various personal expenses, things that you want to take into consideration when you're looking to start something for yourself. Which I think is actually kind of low for the month, $275 in food expenses. I actually spent a ton more on groceries anymore. I think like anybody who has is married or has kids and stuff like that, it's probably going to be more than $275. It's
Way
like
more than $275.
Oh yeah, are you? Family of 5, Chrissy, really? No way.
Right, yeah.
200, yeah. So, but that's another point, guys. When you fill something like this out, be authentic about it. You know what I mean? If it's not $275, put a real amount, because if you're shorting yourself, I mean, if you're, I don't want to say lying, but if you're stretching the truth in a matter of speaking as to what you need, that's not going to serve you well if you're going to enter into business, all right? Startup and prepaid expenses. On that first slide in Chrissy's template, the Excel, you saw a little bit of a variation on a theme, if you will, okay? The various things that you need to start up, whether it's fixed assets, oftentimes fixed assets, and what that entails. The various inventory. If you're looking to start up, you have a store, you want something to sell, right? Otherwise, it's not much of a store. And then the various things that you need to start up from a professional services perspective. You're probably going to want to engage an attorney, or an accountant, the various licenses. Certainly in that example with the bar and the liquor license, okay? And then business debt, the cash that's required, the amount that you're looking to finance, and what you can contribute to the operation, all right? If you're looking to have employees, this is a great way for you to break down what that might be, okay? In terms of like what your estimates are, how much is going to full-time wages and how much is going to part-time, right? And just let me know if there are any questions, but a lot of it is self-explanatory. It is, but it also takes a lot of thought. Okay, and the various things that you anticipate to have to pay out on a month-to-month basis. The advertising, and this is also a great way, this is a great tool for you to be really reflective and cognizant of what your strategies are going to be. Advertising, is it going to be billboards? Is it going to be social media? Is it going to be newspaper stuff? And having that reflection about you informs your costs, right? Delivery expense, if you're that kind of restaurant that that delivers pizzas or like meals and stuff like that to residents and businesses. If you're the type of person, or if you're in a situation where it makes more sense to lease your equipment, maybe you're into a situation where the equipment kind of gets outdated really fast. Like if you're like a programmer or something like that, maybe that makes more sense. All right. It's a lot to think about. vehicle usage if you have to do like a lot of traveling. You know, and quite honestly, not all of these might pertain to your operation, right? But at the very least, it keeps you cognizant about what might. And that's pretty much it with that, okay? Repairs and maintenance, you know, that's something that a lot of folks don't think about. But if you're purchasing used equipment, or if you have a situation, let's just say you're a printer where you have maintenance intervals, these are things that you need to take into consideration. So yeah, like I said, a lot of stuff to think about. Owner's draw, what you intend to pay yourself out of the operation, okay? Cost of goods sold, like Chrissy said, this helps you to determine what your direct costs are, whether it's the purchase of inventory. Because remember, guys, like if you are purchasing something, your direct costs are only accounted for once you actually realize the transaction. Like you could have inventory and it's sitting on a shelf, right? But you don't really expense it until you actually sell it, okay? That's where that comes into play. How you figure out revenue estimates. If it's a transactional sort of situation where you're selling a product, the one equation, and I didn't want this to be like a big equation thing that we talk about, but revenue equals price times quantity. So take that into consideration when you're looking to establish your revenue projections, right? How many customers times how many like widgets, or the price of, you know, of the widgets is what I mean to say. And that's pretty much it. Like I said, this is a lot of text. I didn't want to go into it. And quite honestly, when you do, if you haven't already, but when you do engage us, your SBDC, and you do engage with a consultant, you definitely have access to these tools. So if there are no more questions, let me just make the screen a little bit bigger now. All right. And I guess that's a really decent foray. What now? The whole what now sort of situation, right? Well, this is a lot, I feel, to take into consideration. It's a lot to digest. So please feel free to set up an appointment with me or Chrissy or the other consultants. Actually, we have another one online too. Jackie is one of our consultants too. All right. And through this, through our one-on-one consulting, we can talk about, you know, the technical assistance and the other matters that revolve around what you need for financial projections, okay? What's really important is to reflect on what your project budget is going to be, all right? Like if it's going to be stratospheric, maybe it's a little too much risk for you to take on, okay? Especially if upon further review, maybe you're not expecting the type of revenue figures for the first year, the first couple of years that you originally thought, or you just don't feel comfortable with the amount of capital you have set aside, okay? Relatedly, you want to explore the expenses that you would incur on a monthly basis, because things like rent, things like utilities, they're not going to go away month to month, right? So you want to make sure that what you're doing is going to pay for those fixed costs when you get right down to it. And then of course, closing with that last slide and closing with this, make a concerted attempt at understanding your revenue, the whole price times quantity situation, the number of customers you anticipate servicing, and then the reasonableness of your sales, right? Are you taking into consideration seasonality? Kind of like what we talked about with like the nursery or the Christmas tree farm. All right, and what else is there to discuss? Guys, with something like this, if anybody's a fan of board games, my wife's a real big fan of board games. It's important, right, to learn what the rules are of the game before you actually try and play it, right? And what we've tried to establish for you is just to understand what the various rules related to projections are, okay? And those rules consist of the various statements, okay? The strategies as to how to assign numbers in a matter of speaking to those statements come a little bit later, all right? Figuring out your figures and being able to articulate where those figures were, how you determined those figures to be. And that's something that's commonly referred to as the written assumptions of your financial statements, of your financial projections. Folks, with the whole COVID-19 pandemic, this has become a lot more important because when you get right down to it, a lot of loans have gone bad. Startups have their own share of risk as a result because by nature of something that's just being started up, you don't have a lot of history and banks don't have a lot of history to go by, right? So now it's become a lot more important to pay close attention as to how these figures were derived, okay? It's a really big part of what banks call their underwriting processes and the procedures associated with credit administration. So that means getting it right is even that more important. And then ultimately, kind of like what Chrissy said, but it's such an important point to drive home. You're in the driver's seat with regards to the creation of financial projections. We can certainly assist, but you're the one in the driver's seat, and for sure, don't feel like you have to go through it alone. That's why we're here, to offer you this technical assistance and guidance to help you develop something that not only is something that is palatable to banks vis-a-vis their risk appetite, but also something that could be authentic to your operation. So I think that's pretty much everything that we have to discuss for you. Questions, comments, we are happy to entertain right now.
I could ask a question. I don't know if it would be you or someone else at the school. Who do you talk to about establishing an internship program with your business?
In terms of interns, is that right? You're
Yeah.
talking about internships. So we have
That is actually sharing information.
Bill, did you get that?
No, it was
Okay.
all gobbly.
Right. So what Chrissy had mentioned was we actually have a student development director, Sharon Castano, and she actually orchestrates internships for the students at Wilkes University. So that might be something to take into consideration. If that's something you're serious about, we can certainly pass on her information to you.
If you would, please, yes.
Okay, sounds good. Let me make a note of that. Bill, may I ask, what kind of business do you have, or what kind of operation?
Financial services is the main thing. Yeah.
When you say financial services, do you mean things like investments?
Investments, insurances,
Okay.
a number of other things.
Good for you. And are you just starting up, or
Sort of, yes.
okay.
I was inactive for a number of years and so I'm starting up again, yes.
Okay.
I got my first licenses back in the 90s, but got reestablished again a few years ago. I also teach insurance licensing for a company too.
All right, awesome.
But yeah, there's a great need right now for people, like for financial wellness,
Hmm.
things like that, especially with people that are hurting right now financially.
Absolutely, and it sounds like based on your type of operation, it could be a worthwhile opportunity, for folks looking to
Yeah, I mean, the mission statement's to help people get out of debt, save more money, and be able to retire.
Cool.
Full picture.
Yeah. All righty. Thank you for sharing.
I just wish you sometimes had more people on because you had good stuff. It's just very few people are listening or I don't know how you guys promote this. Anytime I've been on, it's been very few people other than maybe 2 or 3 of your people, and then just a small handful of us. But you got a lot of good information that some people could use.
Yeah.
I still think you're a hidden secret in this area, but
Thank you.
that's
Thank you for that. We did, yeah, we worked pretty hard putting this together, and honestly, because of the nature of our operation, I'll be candid, we don't have a lot of monies dedicated to marketing, and a lot of our reputation is predicated on word of mouth. So, you know, as you go through and obviously reignite your business and come into contact, if you feel amongst your clients they could benefit from our services and our technical assistance. And I guess this goes out to anybody who is attending our, you know, our webinar. You know, please share our information with them. We would greatly appreciate
now
it.
because there's such a low attendance, but you do record these things. That still can be a powerful tool if enough people know about the recordings.
Sure. And I believe, and Joe can actually step in if I'm like totally lying to you, but I believe we actually post these sorts of things on our YouTube channel.
Yeah,
We-
she sent that to me because I
Okay.
asked her because I couldn't remember where it was. I forgot. I can't look at my email and listen at the same time and take notes. So, yeah. But I'm saying the people that have missed this whole thing, they still have someplace they could go and catch it at their own time.
Mm-hmm.
So you could probably reach a lot more people if they knew about the recordings because the information's still there. You know, that's good.
Thank you. Okay.
If there aren't any other questions, we can wrap up the webinar tonight. I'd like to thank Ray and Chrissy for being here with us this afternoon and sharing their insights. I just have a few housekeeping notes before I let everyone go. Like we discussed, I will be making available the recording of the training on the Wilkes SBDC YouTube channel, and I'll be sure to email that link to all attendees.
Thank you.
And our last session in this series will be on licensing and registrations, and that will be next Tuesday, February 9th at 5 p.m. Also, we have 2 new webinars coming up. The first is how to attract and retain top performers, which will be held on February 11th at noon. And our second is cybersecurity for the small business and remote worker, and that will be held on February 26th at noon. And as with all of our webinars, you can sign up for these through the eCenter. And with that, I want to thank everyone for attending this session. And if you have any questions, please do not hesitate to contact us at the SBDC. And I hope that you have a wonderful rest of your day. And I look forward to seeing you at the next session. Have a great afternoon, everyone.
Thank you.
Bye.